Welcome to Seth Farbman on podcast, from startup to stock exchange.
Good afternoon to all the listeners of the podcast today. I want to welcome you to what is going to be really an insightful, an educational, and exciting episode, because recently we've had the opportunity to really look at some of the IPO transactions from a different perspective. You know, I had mentioned on the last episode that historically I've had the opportunity to sit with startup founders and CEOs of publicly traded companies. But what I found interesting recently is the perspective of some of the professionals that are looking at the initial public offering process with different types of glasses. And for today's podcast, I thought it would be helpful and of added value to the CEO audience that listens to this show of what is the perspective of an auditing firm and of professionals that are highly involved in the SPAC world. For those of you that don't know, that is a special purpose acquisition company, and we're going to dig in both at a high level and at a nitty-gritty level. So to jumpstart things, I'd like to introduce, or have them introduce themselves, three very talented guests, Jay, Mark, and Mike. I'm sitting here today in the middle of New York City at Withum. First of all, good afternoon, gentlemen. Welcome.
Good afternoon. Seth, thanks for having us today. Appreciate it.
My pleasure, and thank you for having me here. Jay, why don't you get started? Give us a little bit about yourself individually, and then we'll talk about the firm, and then we'll get started on the really the focus of the afternoon about SPACs.
Sure. So my name's Jay Shepulski. I reside out of our New York office, and I run our SPAC practice along with Mark Deters. SPACs have been a priority for us for the last few years. As you mentioned, Seth, reached $10 billion through 9/30 of this year, and we lead our SPAC and SEC practice. So looking forward to speaking a little bit about the SPAC practice in the SEC world as we see it today.
I'm Mark Deters. As Jay had said, I help run the SPAC practice here at Withum. I've had great success over the last 2 to 3 years as the SPAC market's taken off. I've been fortunate enough to be involved with the two largest SPACs that have ever been launched, both over $1 billion, one at my prior firm and then one here we did at Withum.
Good afternoon. My name is Mike Tenny. I'm similar to the story of the two gentlemen already. Work here at Withum, spending my time in the SPAC practice as well as in our financial service group, dealing with venture capital and private equity funds.
So we've got an all-star team here today. Good thing I'm not being billed by the hour. Okay, so I have a couple of questions that I think some CEOs would like your perspective on. But before we get to those questions, let me ask you to give a high-level overview of what is a SPAC. What should somebody know about why a company would go the SPAC route?
A SPAC is really a blank check IPO. So it's a shell company. A sponsor group comes together. They get a promote of that IPO side of it. They'll launch a public offering, and then they'll raise funds. Typically, now we've seen the average raise to, I'd say, about 200 million, maybe 250.
240 million, yeah.
Really, that high?
Yeah.
Wow, okay.
And that money will get raised and will be placed into a trust account. And then the sponsor group will go out and try to acquire an operating business. And most of the time it's private. And then they'll take that company public through the SPAC vehicle. Ordinarily, it's through a reverse merger structure.
So just to clarify, when the company is going out today, raising money, $200, $300, $400 million, the investors have no idea what the business is that they're investing in, other than that they may know a specific category that the company is leaning towards.
Correct. Most of the SPACs have an industry that they would look to, especially with the management team they line up. But a lot of times, they won't know the target, only the industry side. However, their money is secure because it gets put into a trust account and they get to vote and put the share back. There's a redemption feature on the shares they buy so that they would get their money back out of the trust account if they don't like the target company that's found.
And what's the typical time frame that this money is tied up for?
It's usually between 18 and 24 months.
Okay, so money gets invested today. Money is tied up for 18 to 24 months. The management team then goes out and they find a prospective company to acquire. And then that team stays on to manage the new business?
That varies depending on the structure of the transaction. You have serial SPAC groups that'll do multiple SPACs, and they will take a target public and then they'll step down and they won't really be involved with the management of the company moving forward, and they'll go into another SPAC. In some instances, yes, the management team will stay on board from the SPAC and run the operating company.
So really what the company is asking the shareholder to do, and I know this is not an investment banking discussion, but I guess what I find interesting is when we sold Vintage Filings, seems like only yesterday, but it was back in 2007. As soon as we sold it, we were approached to do a SPAC because it was in vogue at the time. And we'll talk about one of the things I'd like your input on is why it seems to sort of come in and out of fashion. But as soon as we sold Vintage, like immediately we were approached by different firms, and they said, oh, you guys should do a financial services SPAC, as if because we had one exit that made us, sort of financial services experts. And so my question is, really, in these scenarios, you're asking the shareholders to bet strictly on the jockey because there is no business to bet on at this point. Is that right?
Correct. I mean, just to segue into that, to your point, back to the 2006, 2007 genre, right before the economic crisis, there's probably 50 to 60 SPACs a year. The average raise was between right around 100 million. So at the end of the day, if you fast forward now to where we've had 10 billion in SPAC IPO proceeds the last 3 years, I mean, it's really made up a significant asset class where really it makes up around 20% of the traditional, IPO market. So really, yes, the sophistication of the management teams have gotten greater. You have large private equity and venture capital firms entering the mix. And also New York Stock Exchange and NASDAQ have lessened their filing requirements as it relates to the SPAC vehicle. So it's definitely evolved over the years. There's been different structures within the SPACs, but it's definitely been cleaned up and brings us here through today. Through 9/30, you have 10 billion in IPO SPAC proceeds through 9/30.
So
it's to Jay's point, the management team, the jockey, as you called it, the management team and the CEO, the CFO, and as well as the board they're putting together is what they're betting on, right? The track record. One of the, we look at the S1 there, and one of the most important parts is that description of what they've done and what their track record is and what they can bring to the table to when they do find that target, how can they take that target and grow that business, right? That's the ultimate value in the SPAC.
Well, that's what we see time and time again. Or in theory, if you've got an executive team that has had success, I mean, what's that typical disclaimer that prior success is no indication of future? But essentially, you're just assuming that they've got the operational skills and the technical skills and the gut to be able to do it time and time again. It seems like the work that the three of you have done in the SPAC industry is a bit of a niche. Before I ask about some of the expanded services that you bring to the table, what about the SPAC audit work or accounting work makes it unique that allows Withum to stand out? Or tell me a little bit about Withum's background that sort of got you to this point where I believe you've done, if not more, at least you're certainly one of the leaders in the category. How did you get to this point, or how did you fall into this category?
Sure. So from the SPACs, I mean, we've been doing SPACs, for 15 years now. So, at a prior firm.
You started when you were 20.
Yeah, exactly. Okay. So we were at a prior firm and we, did a lot of transactions back then. And then after the economic crisis, it went dormant for many years. And then there's been a huge uptick. I think from our perspective, what we look out for and, helping our clients and, our sponsor groups and then working with the attorneys and the investment bankers, we're able to be nimble. We realize in the beginning of the SPAC, the accounting isn't overly complicated. You have, really things focused around warrant, forward purchase agreements. But really, we try to stay ahead of that. Anything that's going to be cutting edge with the SEC, whether it's a new high-profile SPAC that's out there. For instance, when we did CF Corp and they introduced the, forward purchase agreement, we try to stay ahead of the SEC issues, and working with the outside consultants and the attorneys in that regard. But in our business, we need to be nimble. If the company's changing, upsizing, downsizing, they have to change gears and get an audit report done, within a few business days after doing so. So we're able to be nimble. We have experts on our team. We have 15 folks that are fully dedicated to SPAC practice and 5 partners. So I think that's how we are able to handle the work.
But let me interrupt you there, because to the layman, which I put myself in that category, you would think, well, there's not that much to be done up front, right? In other words, I remember back in the day, which I try not to think about, when I was a practicing securities attorney, people would always say like, oh, what's the big deal in putting together the Form S1? It's just, you take the format, you plug in the name, you drop in some numbers, it shouldn't take you more than an hour. Little do they know. And so along those same lines, I would imagine people say, well, what's there to it, right? To do an audit of a company that was literally just incorporated, an hour ago, is most of the heavy lifting of the work that you bring to the table done on the acquisition side, or is there really a lot of work to be done, throughout the whole process?
Yeah, I think what you'll find is raising the IPO proceeds is really 20% of the offering. The real work begins once you have, the money's in the door and the management team is then looking for a target. Once, the initial IPO phase from A to Z isn't overly complicated. Like I said, you have a few warrant agreements and things of the nature that, equity versus liability treatment on certain items. But once you're up and running, really staying ahead with the, accounting target acquisition requirements, with the audit committee, the CFO of the SPAC. I mean, those are the big things that we really try to stay ahead of.
Yeah, I think that's where you see the delays. Like Jay had said, the front side at this point is pretty set up to run itself. I mean, we work well with them and we work quickly so that we don't hold the process up, because really, the timeline's driven off of the underwriters and the sponsor group and their marketing timeline. We want to make sure we're not the reason that they don't go to market the day they want to. So that's, from a nimbleness perspective, we react very quickly and get them on file quickly. But once they're public, it's really, we've seen audits hold up transactions because the target company wasn't ready. And they weren't sure exactly how many years were needed, and the audits needed to be PCAOB, and the sponsor groups weren't aware of that. So we really try to stay on top of that, inform them as they move through the process, and give them questions and are there for their questions so that they're ready to understand how the timeline is going to be affected by the readiness of the target company that they want to acquire.
Now, there are all types of these acronyms that, seem to be more prevalent in our business. As a transfer agent, well, even as an Edgar agent, right? There was Edgar, there is DWAC and DTC and DRS and, even SPAC for that matter. I've also heard the term used by you guys, DSPAC. Clarify, what's a DSPAC? And you'd mentioned a transaction about DSPACing. Talk to me about that.
So the de-SPACing is obviously the process when the SPAC does find a target to acquire. And to Mark's point, there are a lot of accounting requirements that are involved when you find that target. When you do find that target, most of the time you're looking at a target that is audited. They need to be under the rules. They need to be on PCAOB standard audits,
which is unique for a SPAC versus a standard operating company. You've seen a standard operating company do an acquisition. They already have an audit. You put an audit in the 8K and you move on.
That's a good point. Yeah, that's a good point.
There's a special rule written into the SEC reporting guide that forces the SPAC acquisition to be PCAOB audits that go into the proxy document or S4 document.
Okay.
So most times you do find a target that's fully meeting the requirements. Sometimes you find ones that were audited but need to be upgraded from a private company audit to a PCAOB audit. And sometimes you find companies that are actually unaudited. We actually recently had a SPAC, GTY Technology Holdings, that ended up finding 6 instead of 1. Typically, they find one target. This one found 6 unaudited companies.
And they wanted to do that simultaneously?
Simultaneously. So yes.
Showtime. No pressure on you guys. Okay.
No, difficult task, but we worked with the SPAC and the team, and we were able to be the auditor of record of the 6 individual companies.
Wow.
And help the SPAC throughout the process and through the transaction, and ultimately bring those six companies audited under PCAOB standards into the proxy, and ultimately they got shareholder vote back in February and became a public company now with the SPAC and the six company roll up.
Wow, nice.
It was very
a lot of work,
yes.
A lot of sleepless nights, I'm sure. Let me ask you this question. In terms of, I find very often that people are very appreciative when I'm able to dispel a myth that they have, and that's some sort of like value add that they're like, oh, I wish I would have known that beforehand. I'm going to ask you to name sort of one myth that you can dispel for some of the listeners here in the audience. I'm going to give one of my own pet peeves, and one of my own pet peeves is, on the transfer side, a lot of times people get upset at us when it comes to depositing the shares or depositing the securities, and very often that's an issue that ends up being that has to be handled on the clearing side, nothing to do with the transfer agent. When it comes to SPACs, one of my own pet peeves is people say, oh, well, the transfer agent has to be the trust and they have to be the escrow agent, when in fact that's not true. Almost every transfer agent actually just uses, JP Morgan Chase, or they outsource the actual escrow banking relationship, as do we. We have a phenomenal relationship with Wilmington Trust. So I think sometimes when people start to peel away some of the layers of complexity and they see just how simple it can be, it makes the SPAC process a little bit more attractive and a little bit more accessible. Is there, either one of you or three of you, is there any sort of myth that you think is out there that people feel like, oh, a SPAC is not for me because of this, when, really that's not the case, or something on the accounting side that people would benefit from knowing?
I think one of the biggest myths or hurdles is when we speak to sponsor groups and some of the most prominent private equity venture capital groups in the country, is just the use of an outside consultant in the SPAC process. So folks initially think it's very simplified, but 9 times out of 10, once the IPO is done, the CFOs and the CEO thank us for introducing them to an independent outside consultant. Because what happens is the folks have their day-to-day jobs. Their highest and best use is usually, like you said, relying on the management team to find a suitable target. So the day-to-day infrastructure, a lot of times they're wearing 3 to 4 different hats, and it's nice to have that consultant in place to help them with books and records, assisting with the financial tables that go into the S1 document. And then down the road, as they do find a target, someone independent of the outside auditors who can provide guidance, independent of the auditors, help with the pro formas, the Article 11 pro forma adjustments that go into the business combination, the proxy. So I think that's one of the myths that, there's only 5 accounts on the balance sheet initially. We don't need any assistance. But then when you're changing deals, upsize, downsize, they're 9 times out of 10, like I said, they're thanking us for introducing someone that could help support the team.
To that point as well, once you do the IPO, you're a public company. While
Right.
it is a shell company,
Right.
it's SEC reporting. You're doing Form 10Qs, Form 10K. Most of the people that launch a SPAC, if they're coming out of the private equity world or the venture capital world, they're not used to public company reporting. You also have to schedule, quarterly meetings with the audit committee and the board of directors, and it's a lot different. And that's when the switch gets flipped. You're a public company, and
Right.
you're under public company reporting guidelines.
And we always tell these CEOs that you now wear 2 hats, if not more, right? One is running your business as a business, and the other is literally a full-time job, whether it's answering shareholders and keeping an eye on the stock and doing conference calls and earnings reports and things like that. I've never done the research, but is it not the case that executive dream team management usually has somebody with public company experience, or is it maybe not so?
They do. They usually have people that sat on boards,
but not necessarily really.
Not somebody at the granular level to do the
that's
accounting and the
interesting.
reporting side. That's why the consultant helps, because there's a few groups that have done quite a few SPAC transactions. They know how to do it and the timeline that's required with it.
Interesting. Well, that's important to definitely have, because living the life of a public company is always exciting. We could definitely categorize as that. Let me ask you this. We're sitting here talking at a very high level to companies that are going public and raising capital, contemplating doing a SPAC. But, I would be remiss if we didn't touch upon, at least briefly, the fact that we are sitting in right now one of the hottest times of the IPO industry as a whole. Peloton, Lyft, Uber, WeWork just pulled this week. That is an area that your practice concentrates on as well. It's not just limited to SPACs, correct?
That is correct. We do have a wheelhouse for company sizes, from the emerging growth companies, from a startup to, I'd say, 400 million would be our sweet spot. So smaller reporting registrants is right in our wheelhouse. But yeah, Withum is a one-stop shop firm, full service, from A to Z in that regard as well. But yeah, SPACs is one asset class that we touch on. But in addition, our industry verticals, one of our largest niche happens to be our tech niche, which we audit over 400 companies in that genre. So it's very synergistic when we have our venture capital backed sponsor groups. Our financial service niche does private equity, hedge, venture capital audits, and then the underlying portfolio companies within those umbrellas, whether it be healthcare, manufacturing, tech, life science. So it's a very synergistic group, and we work well with them. For instance, on the GTY, we utilize 20 of our tech folks to complete that audit in a tight time frame. So we leverage off those resources when needed as well.
Yeah, I've got to imagine you have to know a little bit about every industry. That's actually a good point. Do you have any particular industry that you specialize in, or you're agnostic in terms of, numbers are numbers, or is there a particular area that you specialize in?
Yeah, I would say, so Withum is a $250 million firm, top 25 firm. I would say our largest two niches are financial services and tech. So that they comprise about, in aggregate, 20% of our industry verticals. So those are definitely our sweet spot, areas of expertise that I would say we have a concentration.
Yeah, individually we have a lot of different industry groups, and we specialize by industry. So from the SPAC side, we know the SPAC very well, but when you get to the target company side, we'll bring in an industry group that specializes in that area. Withum's broken up by industry.
Got it.
So that we specialize within that group, so that we can obviously know the ins and outs of.
Yeah, the great thing about Withum is we do have a lot of different industry verticals. We plan to cover a lot of these areas: automotive, construction, manufacturing, professional services, real estate. We really have sort of everything kind of covered, which is great. So there's really not too much out there, in it's very specific industries out there maybe would be out of our wheelhouse, but we can cover most of them.
Awesome. So, I think we've covered SPACs, we've covered IPOs. Before we wrap it up, I want to digress for a minute from the specifics of the topic, and I want to go a little bit broad. There are also people that listen to this podcast. It is called Startup to Stock Exchange, that are in that startups phase where they're not sure what type of job they want to do, what kind of company they want to start, what type of industry they want to focus on, and there are some people that are attracted to being an attorney because they love the law. My partner, Yoel Goldfeder, God bless him, calls himself this, so I can. He's a securities nerd. He loves reading regulations. I myself never had a fascination with the law. Makes me wonder why I went to law school. However, the three of you, as accountants, as auditors, let me ask, what made you get into this specialty? Do you love numbers? Do you love accounting? What is it that makes you love what you do?
I'll kick it off.
I don't mean to put you on the spot.
No,
I just thought it would be a good way to end it on a more personal note.
Yeah, I'll share this story. It's a little bit embarrassing even
better than
I wouldn't motivate anybody in college right now to do this. But, for me, I was always, pretty strong in mathematics, numbers, analytics, things like that. But, thinking outside the box, back to being a junior in college, I remember walking up to Commons with my roommate, and we were discussing, what was going on as far as career decisions. He said we had to choose a major by Friday. So I asked him what he was doing. And he's like, I'm going to sign up for accounting. So I walked in with him, and I knew I had that backdrop, and I just went with it on a gut and impulse. I knew accounting could branch off into various things. I mean, you could do public accounting, you could be the CFO of a company, you could be entrepreneurial in a startup. So, that's the great thing about accounting. I think it's versatile. I think, obviously being a CPA, no one can take that away from you.
Right,
And
right.
it branches out into many different things.
Plus, you probably don't have a problem helping your fourth grader with his homework, as I do.
Absolutely not.
Okay,
Yeah,
just
I don't know.
Just checking.
Now,
The complicated algebra.
now, I will say there are guys like the gentleman to my left here, who's our 606 expert and reads literature every day. Because
I don't know what that is, but that sounds impressive.
That's recognition.
Okay.
So there's different varying genres, but Mark has an appreciation for that. So I'll let
Okay.
him speak to
Yeah,
you.
Mark.
So same thing as Jay. I mean, I don't know that I necessarily love numbers and math, but I was just good at it and
okay.
efficient at it. And it just gravitated towards, it was easy for you. It came easy for me. And that's where I ended up. I do actually enjoy a little bit of the research side of it and understanding how things happen. And even branching back to the SPACs, I know probably pretty immediately whether a warrant that they're issuing is going to be a liability or not, just because I've read so much about it.
Okay.
But so I actually do enjoy the research side of it a little bit more. But yeah, I think it just came from being good at numbers. But I personally enjoy going out more and meeting, especially the SPAC group has opened us up to a lot of different individuals that we ordinarily wouldn't get in the room with, executives at Blackstone and different things like that, where I enjoy that side of it, meeting different people and understanding how they operate, and you see them in the business world. And that's my favorite part.
I think that's I think that's a really important part because, so often people think, well, I'm either good at math or I'm good at sales, and I don't have necessarily the ability to combine the two to be the rainmaker and a partner that has the ability to actually do the work. It looks like the three of you have both those skills to actually do the number crunching and the infatuation with Excel and spreadsheets, but you can actually, go to the meetings and close the deals, which are important. Mike, what's your love?
Very similar. I do love numbers. I do love Microsoft Excel, so I'm not going to complain there. But
Nothing to be ashamed of.
No, but as Mark's point, the relationships are great. The problem solving. One thing about coming to work every day, there's something different that happens every day.
Right.
Some new problem, something else to solve, and something else to figure out. I also love the relationships. So we get to deal with on the SPAC side. We get to deal with sort of some people that we don't typically get to talk to and learn about what they're doing.
Like transfer agents, we don't get to talk every day, but
Yeah, and the SPAC's not the only thing they're doing. So
Right,
that's
right.
always interesting. On the other side, the venture side and the private equity side, I love talking to those GPs and understanding why they're investing in certain companies and seeing those companies. So it's just a lot of different ways to do it. It's the accounting is fun, the math and the Excel and the auditing and the financial statements can be interesting to me and the research, but those relationships and those different things that happen every day are important.
Yeah, and I think the biggest thing for us too is, from this without saying, is, we 5 years ago, we were at a prior firm that was acquired by a big four. So from an entrepreneurial standpoint, we joined, with Withum's practice and, started, grassroots again with, the SEC financial service side. And it was very entrepreneurial because, we had a pretty strong, prominent name, at our prior firm. And we grew that. We started with 100 employees, grew to 1,000 to a $200 million firm. And it was a strong financial service practice that was acquired, strictly for hedge fund, private equity, VC. And it was acquired by the big four. So we kind of got the band back together. Really it comes back to the people you work with, growing that practice and, having a genuine interest in their careers and grow together. And that's kind of what we replicated with the culture here. It's always been firm's been around for 40 years, great culture. And now we're just excited to have a platform to grow again and be working together. And like you said, you get to work with some of the most prominent private equity venture capital firms in the country. And there's the human element to it, just seeing these entrepreneurship and their companies grow and exit.
Well, you say you got the band back together. It sounds like you guys are making some good music. So I appreciate, again, the chance to sit with this all-star team here today. And hopefully we'll have the chance to hear more about other transactions and other opportunities. So thank you again for your time, guys.
Appreciate your time,
Thanks.
Seth. Thank you.